January 28th, 2026, silver crosses RR's 4 lakh per kilogram in India. That's approximately $149 per troy ounce in dollar terms. For perspective, in January 2025, silver was trading around $189,000 per kilogram. That's a 349% increase in rupee terms in just 12 months. In dollar terms, the metal reportedly surged from approximately $27 per ounce to over $149. A 451% gain year over year. This isn't just price movement. This is what market observers call a structural shift. And investors around the world are asking the same questions. Is this sustainable? How do I understand this volatility? What does history tell us about what happens next? In the next 30 minutes, I'm going to walk through what's actually happening in silver markets. Not with predictions or recommendations, but with patterns, data, and historical context. I'll show you the mechanics behind silver ETFs, the warning signs that preceded every major precious metals correction in history, and frameworks for understanding volatility. This isn't financial advice. I'm not telling you what to do with your money. I'm showing you how to think about volatility, how to understand what hedging actually means, and patterns that have repeated throughout commodity market history. The dual narrative. Two different stories. When silver rises 451% in dollar terms, but only 349% in rupee terms, the mathematics reveals something critical. The rupee weakened significantly against the dollar during this period. In January 2025, USD INR was trading around 83. By January 2026, reports suggest it's approaching 88.90, representing depreciation of approximately 6 to 8%. Here's what this means. For an Indian investor, silver provided a 349% return in local currency terms. For a US investor, the same metal delivered 451%. The difference is currency debasement. The dollar bought less silver, but the rupee bought even less dollar-denominated silver. This dual narrative creates a critical insight. Part of silver's surge is metal appreciation. Part is currency depreciation. Separating these two factors matters enormously because they have different durability characteristics. Metal appreciation, driven by supply deficits or industrial demand, tends to be more durable, potentially persisting for years. Currency depreciation-driven gains are more fragile and can reverse quickly if central banks adjust policy or confidence shifts. For Indian investors specifically, the Rs 4 lakh per kilogram level represents both opportunity and risk. If the rupee stabilizes or strengthens, silver's rupee price could decline even if dollar prices hold steady. Conversely, if the rupee continues weakening, silver could provide currency hedge benefits independent of metal price direction. Understanding this dual narrative is the foundation for everything that follows. What actually happened? The 5 drivers. Let me walk through what market observers have identified as key drivers behind silver's extraordinary move. First, industrial demand acceleration. According to industry data, approximately 56 to 60% of silver consumption comes from industrial applications. Solar panels are the largest single driver, with global installations reportedly doubling between 2024 and 2025. Electric vehicles reportedly use 25-50 grams of silver compared to 15-25 grams in traditional vehicles, with EV production growing 35-40% annually. Add 5G infrastructure, AI data centers, and medical devices, and analysts describe a structural deficit where consumption exceeds mine production. Second, supply constraints. Silver mine production hasn't kept pace with demand growth. Most silver comes as byproduct of base metal mining. When base metal prices are weak, silver supply falls as collateral damage. High-grade primary deposits are increasingly depleted, requiring more energy to extract less metal. Third, monetary debasement concerns. Central banks globally have maintained elevated balance sheets from pandemic-era interventions. When investors lose confidence in fiat currencies, they historically rotate into hard assets. Gold crossed $4,200 per ounce in January 2026, according to market data. Silver followed proportionally. Fourth, paper market stress. The silver futures market on COMEX reportedly showed signs of strain in late 2025, with open interest relative to available registered inventory reaching concerning levels. When paper markets face stress, physical premiums spike. Reports suggest physical silver coins and bars traded at 25-40% premiums over spot prices during peak demand. Fifth, geopolitical fragmentation. Trade tensions and resource nationalism have disrupted supply chains. When governments compete with private buyers for strategic reserves, available supply shrinks. These 5 factors converged in 2025, creating what market participants describe as a perfect storm. Understanding silver ETFs, the paper hedge. An exchange-traded fund holding silver provides exposure to silver prices without requiring physical possession. Physically backed silver ETFs like iShares Silver Trust hold actual silver bars and vaults. When you buy shares, you own a fractional claim on physical inventory. These ETFs publish daily holdings reports showing exactly how much silver backs outstanding shares. Synthetic silver ETFs use derivatives and futures to replicate silver price exposure without holding physical metal. These are more common in jurisdictions with storage constraints. The distinction matters during stress. Physically backed ETFs can theoretically deliver metal, though redemption minimums are large. Synthetic ETFs cannot deliver metal. Only cash settle at prices that may diverge from physical reality during dislocations. For those considering silver ETFs, several factors warrant attention. Liquidity. ETFs trade on exchanges with tight spreads under normal conditions, making entry and exit straightforward compared to physical metal. Storage elimination. No need to secure, insure, or transport physical silver. Fractional exposure. You can buy small dollar amounts of silver exposure through ETFs, rather than buying full coins or bars. However, ETFs introduce counterparty risk. You're trusting the fund structure, custodian, auditors, and legal framework. In March 2020, during the COVID crisis, silver ETFs briefly traded at significant discounts to net asset value because logistics breakdowns prevented efficient arbitrage. Physical silver carried 60 to 100% premiums, while ETF shares traded below the value of underlying metal. This is the core tension. ETFs provide convenient exposure during normal times, but during extreme dislocations, they may not perform as expected. The warning signs. What corrections look like. Let me show you what preceded every major silver correction in modern history. In January 1980, silver peaked at $49.45 per ounce. Within 3 months, it fell to $11, a 78% decline in 90 days. The warning signs. Regulatory changes restricted long positions, forcing liquidation. Industrial users substituted alternatives. Mine production surged. And the fundamental driver, the Hunt brothers buying, stopped when they exhausted capital. In April 2011, silver peaked at $48.70 per ounce. Within 5 months, it fell to $26, a 47% decline. The warning signs? Speculative positioning hit extremes with record net long futures positions. ETF inflows stopped, indicating buyer exhaustion. The dollar strengthened as European debt concerns created safe haven demand. Industrial demand disappointed as global growth slowed. In August 2020, silver peaked at $29.14. Within 4 months, it fell to $20, a 24% decline. The warning signs? Retail buying frenzy indicated speculative excess. Physical premiums compressed, suggesting supply was meeting demand. The dollar found support. Real yields began rising, making non-yielding silver less attractive. Pattern recognition reveals common characteristics. Exhaustion of incremental buyers. Every rally requires continuous new demand. When new buying slows, momentum breaks, supply response, high prices incentivize production increases, recycling, and substitution. This takes time but becomes powerful. Dollar dynamics. Silver is dollar-denominated globally. When the dollar strengthens, silver typically weakens. Real yield shifts. When bonds offer positive real returns after inflation, the opportunity cost of holding non-yielding silver increases. Speculative positioning extremes. When speculators are overwhelmingly long and commercials overwhelmingly short, mean reversion becomes likely. Where we are now. The current setup. As of late January 2026, market data suggests silver has surged 451% in dollar terms from January 2025 lows. This exceeds the 1979-1980 rally in percentage terms and approaches magnitudes that historically precede major corrections. Physical premiums remain elevated according to dealer reports, though not at extreme levels. This suggests demand continues, but may be moderating. ETF holdings have grown substantially. Industry estimates indicate global silver ETF holdings increased approximately 150-200 million ounces during 2025. COMEX registered silver inventories reportedly stand around 85-95 million ounces as of January 2026, down from approximately 120-140 million ounces in early 2025. Speculative positioning in futures markets is reportedly near historic highs. Net long positions indicate bullish sentiment is extreme. The dollar index has been range-bound between 100 and 105 throughout 2025. A sustained dollar rally could pressure silver regardless of fundamentals. Real yields on 10-year tips are reportedly around 1.8 to 2.2% as of January 2026. Historically, silver performs well when real yields are below 1% and struggles above 3%. This creates a mixed picture. Fundamental support remains strong through supply constraints and industrial demand. However, positioning and speculative interest have reached levels historically associated with corrections. The three scenarios, frameworks for understanding. Let me outline 3 scenarios based on historical patterns. These are not predictions, but frameworks for understanding possible paths. Base case, consolidation with 25 to 35% correction. Silver consolidates between $100 $120 per ounce over 6 to 12 months, representing 20-35% pullback from $149. In rupee terms, at USD INR 88 to 90, this translates to Rs 2.8, 3.2 lakh per kilogram. This would be consistent with historical corrections during bull markets where fundamental drivers remain intact but pace moderates. Bull case, continued surge to 200 plus per ounce. Factors that drove 2025 rally accelerate. COMEX faces delivery stress. Physical, premium surge to 50-100%. The dollar weakens significantly. Silver approaches its inflation-adjusted 1980 high. In rupee terms, this could translate to Rs 5.5 lakh per kilogram depending on currency movements. This requires supply deficit continuation, no industrial substitution, persistent monetary debasement, and growing recognition that paper claims exceed physical availability. Bear case, sharp 50-60% correction to $60 $75 per ounce. Economic slowdown reduces industrial demand, aggressive Fed tightening pushes, real yields above 3%, dollar surges, or regulatory changes restrict positioning. In rupee terms, this translates to roughly R 1.8 to 2 lakh per kilogram. This requires confluence of multiple negative factors, similar to 1980, 2011, or 2013-2015. The correction warning system, indicators to monitor. Specific indicators historically signal inflection points, physical premiums, compression. When premiums shrink from 25-40% to single digits, speculative excess may be peaking. ETF flow reversal. When net inflows turn to sustained outflows after a rally, marginal buyer exhaustion is indicated. Gold-silver ratio extremes. Current ratio around 28.1 suggests silver may be approaching relative valuation limits versus historical range of 40-80.1. Speculative positioning in CFTC data. When managed money net longs exceed 75th percentile while commercial shorts mirror this extreme, mean reversion setup exists. Dollar technical levels. If dollar index breaks above 108-110, silver historically faces pressure. Below 98-100, silver finds support. Real yield trajectory. Above 2.53%, opportunity cost increases substantially. Below 0.5%, silver becomes relatively attractive. Industrial demand proxies. Solar panel installations, EV production figures, semiconductor manufacturing indices provide forward indication of industrial silver demand. The India-specific considerations. For Indian investors, additional factors matter. Customs duty and import restrictions. Policy changes on import duties or quantity restrictions create domestic price distortions. Regulatory shifts impact rupee-denominated prices independent of dollar markets. Cultural demand patterns. India has deep affinity for precious metals, particularly around festivals and weddings. Demand surges during Diwali, Dhanteras, and wedding seasons amplify volatility. Currency considerations. Holding international silver ETFs creates both silver and currency exposure. Some investors hedge currency separately, gold versus silver allocation. Historically, balanced portfolios, 60-70% gold, 30-40% silver by value, have outperformed single metal concentration over long periods while managing volatility. Domestic ETF options. Indian exchanges offer silver ETFs with varying liquidity. Major offerings include HDFC Silver ETF, Nippon India, Silver ETF. Comparing expense ratios and tracking error helps identify optimal vehicles. The behavioral traps. Psychological challenges with assets experiencing 300-400% rallies. Recency bias. After 4x gains, the mind extrapolates forward linearly. This ignores mean reversion and diminishing returns. FOMO, fear of missing out. Watching others profit creates pressure to participate regardless of valuation, driving buying at peaks. Confirmation bias. Once positioned, investors selectively consume supporting information, creating echo chambers. Anchoring. First-time buyers at Rs 4 lakh mentally anchor to this level. Falls to Rs 3 lakh feel like discounts, despite being 237% above year-ago levels. Loss aversion. Losses hurt roughly twice as much as equivalent gains feel good. This causes holding, losing positions too long, and selling winners too quickly. The historical perspective. Silver experienced major bull markets in 1971, 1980, 2001, 2011, and potentially 2020 present. These cycles typically last 8 to 12 years peak to peak. The 1971 to 1980 bull market saw silver rise from $1.30 to $49.45, a 3,700% gain over 9 years. The subsequent bear market lasted until 1991, with silver falling to $3.50, a 93% decline from peak. The 2001-2011 bull market saw silver rise from $4.10 to $48.70, a 1,088% gain over 10 years. The correction to $13.60 by early 2016 represented 72% decline. These cycles reveal characteristics. Bull markets feature multiple legs with 20-40% intermediate corrections. Bear markets give back 70-90% of gains. Full cycles typically require 12 to 20 years. If current strength represents the third major bull market since 1971, historical pattern suggests we may be in mid to late stage given magnitude of gains already achieved. This doesn't predict the peak, but suggests caution is warranted. Decision framework. Educational synthesis. Define objective. Are you hedging specific risk, speculating on appreciation, or diversifying? Clarity determines all decisions. Determine base case. After reviewing scenarios, what seems most likely? Assign subjective probability to outcomes based on available evidence. Calculate position size. Use formulas that prevent financial distress under bear scenarios. If bear case involves 50% loss, allocate only manageable amounts. Select vehicle. ETF versus physical. Domestic versus international. Tax treatment, liquidity requirements, all inform selection. Establish entry strategy. Lump sum versus dollar cost averaging. Timing based on indicators. Define exit criteria. Profit targets. Stop losses. Rebalancing thresholds. Establish before emotional attachment forms. Monitor indicators. Track warning signals. Adjust if conditions change materially. Review and adapt. Quarterly assessment. Have circumstances evolved? Do assumptions still hold? Conclusion. Volatility as information. Silver at RF4 lakh per kilogram represents extraordinary price movement. The 349% gain in INR terms over 12 months is historically rare. Such moves contain information about underlying stress in monetary systems, supply chains, and energy transitions. For observers, the question isn't whether to chase or avoid. The question is how to understand multiple scenarios simultaneously. This means accepting that optimal outcomes are unknowable, considering robustness across possibilities, and maintaining discipline to adapt as conditions evolve. ETFs provide liquid exposure suitable for tactical positioning. Physical metal provides insurance against systemic stress. Neither is universally superior. Both have roles depending on objectives. The warning signs from 1980, 2011, and 2020 teach that exhaustion of incremental buyers, supply responses, dollar dynamics, real yield shifts, and speculative extremes precede corrections. Monitoring these provides orientation. The RS4 lakh per kilogram level may represent a sustainable platform if fundamental drivers persist, or it may represent a speculative peak followed by reversion. Observers don't need to predict which occurs. Understanding both possibilities matters. This is not financial advice. This is educational content on market mechanics, historical patterns, and analytical frameworks. Every investor's situation differs, and appropriate positioning requires considering individual circumstances. The volatility you're seeing isn't aberration. It's markets processing information about scarcity, demand, and monetary conditions. Understanding those forces, respecting their power, and approaching with appropriate humility may be valuable amid the chaos. The next phase will be determined by forces larger than any single participant can influence. Studying those forces provides context for understanding what unfolds